Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market reaction to April inflation data and systemic tech investments. This video presents a direct informational narration of the source document. Starting right off with the macroeconomic data, the April U.S. Producer Price Index, or PPI, indicates that inflation pressures are progressively expanding. Yet, despite these underlying pressures, U.S. equities have demonstrated some truly marked resilience. Here's how we'll be breaking down today's explainer. We'll start with the inflation data, market reaction, then we'll look at S&P targets and rebalancing, followed by sector shifts in AI. After that, we'll examine big tech cash flow, move into the debt-funded tech boom, and finally, wrap up with systemic risks and the broader market outlook. Let's dive right into Section 1. Inflation data, market reaction. Looking closely at the numbers, the April PPI grew by 6% year-over-year. To put that into perspective, that is the fastest growth rate we've seen in 3 years, and it heavily surpassed the market expectation of 4.8%. On a month-over-month basis, it grew by 1.4%, marking a 4-year high, and coming in at nearly triple the anticipated 0.5%. Now, even if we exclude food and energy, the core PPI still jumped 5.2% year-over-year. A portion of this is definitely driven by rising energy costs and baseline effects from last year. However, it's worth noting that within this report, the specific components directly linked to the PCE price index, which is the Federal Reserve's preferred inflation gauge, remained relatively stable. But here's the really interesting part. While U.S. Treasury yields spiked sharply in response to this hot data, the equity futures market remained remarkably flat. So, what's driving this resilience? It's largely due to options market gamma mechanics. Specifically, market makers are maintaining a massive passive buy wall near the 7350 support level to manage their risk exposure. You can think of this structural positioning like a giant sponge. It mechanically absorbs negative selling pressure and tightly restricts the index to a narrow volatility band until the option's expirations clear. Meanwhile, the S&P 500 forward price-to-earnings ratio is sitting around 21.4 times. While that is undeniably high, it's heavily supported by the tech and energy sectors. This indicates the market is willing to pay a premium for anticipated high earnings growth rather than just experiencing irrational multiple expansion. Moving on to Section 2, S&P targets and rebalancing. A prominent example of this institutional shift in sentiment comes from Morgan Stanley. Analyst Michael Wilson recently raised their year-end S&P 500 target to 8,000 points, and they're projecting it could hit 8,300 by mid-2027. The core thesis here is that the market has already completed substantial adjustments in terms of valuation and breadth, meaning major risks are fully priced in. The firm posits that structural rebalancing policies, covering trade, taxes, investment, and income, are fundamentally shifting the U.S. economy. The transition is moving away from a reliance on cheap imports and heavy debt toward a model that's highly focused on internal domestic investment and strong earnings growth, structurally supporting U.S. equities in the process. Next up, Section 3, sector shifts in AI. At the micro level, we're seeing some very clear sector rotations as traditional companies evolve their strategies. Take Ford, for example. They're establishing a wholly owned subsidiary called Ford Energy, entering the large-scale battery storage space with a new facility in Kentucky. This signals a major pivot from traditional auto manufacturing into high-growth energy storage. Over in the semiconductor space, AMD's recent filings reveal strategic investments, acquiring stakes in Marvell Technology, SMCI, and even quantum technology firms like Xanadu. And in the software realm, Google is front-running competitors by planning to integrate its Gemini AI model directly into the Android operating layer, moving it from a simple chatbot to a foundational operating system feature ahead of Apple's upcoming developer conference. That brings us to Section 4, Big Tech Cash Flow. Alibaba's Q1 metrics actually highlight this broader industry trend perfectly. While their overall revenue grew a modest 3%, net profits surged an impressive 96% to 23.5 billion RMB, heavily driven by strong performance in cloud computing and AI. However, if we look at the free cash flow metric, it tells a very different story. Free cash flow dropped to a negative 17.3 billion RMB. That's a stark decline from a positive 37.4 billion RMB during the same period last year. This cash burn is the direct result of aggressive infrastructure investments and heavy marketing expenditures to secure a leading position in large language models and cloud infrastructure. But despite this, the company's foundation remains solid. They hold over 520 billion RMB in cash reserves, allowing them to comfortably absorb these strategic short-term cash flow deteriorations. Let's shift to Section 5, Debt-Funded Tech Boom. Current projections show that capital expenditures for U.S. hyperscale tech companies will reach approximately $81 billion in 2026, which is double the estimates for 2025. But looking further out to 2027, forecasts suggest this figure could literally leap to $1.1 trillion to fund the next phase of AI development. So how are they funding this infrastructure build-out? Morgan Stanley projects that 2026 will be a record year for U.S. investment-grade bonds, with total issuance hitting $2.25 trillion. The technology sector alone is projected to account for a historic 18% of this total supply. We are already seeing this strategy unfold right now. Google has issued roughly $50 billion in new debt in just the second quarter, and Meta has issued $55 billion in debt over the past 6 months. Consequently, the cash reserves of major U.S. tech companies are dropping to their lowest levels in a decade. Combined third-quarter free cash flows for top firms like Amazon, Google, Microsoft, and Meta are projected to drop to just $40 billion. That is down drastically from an average of $450 billion per quarter since the pandemic. To sustain this, tech giants are making sacrifices elsewhere. For the first time since its inception in 2015, Google has paused its stock buyback program. Meta has similarly halted its buybacks to redirect those funds entirely toward AI compute resources. Finally, let's cover Section 6, Systemic Risks and Outlook. To manage these massive liabilities and protect their balance sheets, companies are increasingly utilizing off-balance sheet structures. For example, Meta transferred $30 billion in debt to a joint venture where it only holds a minority stake. Oracle is employing very similar strategies. What this essentially means is that the AI supercycle is highly concentrated and deeply vulnerable to any disruptions in the bond market. If AI investments fail to deliver excess returns, or if corporate debt outpaces earnings growth, that risk could rapidly spread from the technology sector straight into the broader financial system. To understand the timeline of these risks, it's helpful to look at historical parallels. The collapse of the internet bubble in 2000 was fundamentally triggered by the Federal Reserve's initiation of rate hikes back in June 1999. Current analysis suggests that market shifts are less about technological overvaluation in a vacuum and much more about monetary tightening. With current monetary policy remaining broadly accommodative, the consensus is that the AI value validation window will remain open for the next 2 to 3 years. Until the Federal Reserve fundamentally restarts a rate hike cycle, major structural bursts are considered less likely, though we should certainly expect severe volatility and sector rotations. Ultimately, the entire market architecture right now relies on uninterrupted access to capital. So the crucial question we are left to monitor is this: how long can this massive debt-funded AI infrastructure cycle actually outpace the Federal Reserve's monetary policy window? Understanding the intersection between these unprecedented corporate bond issuances and future central bank decisions is going to be the defining metric for the market's path forward.